What if I told you your Bitcoin could pay you yield without actually ever selling it? Sounds too good to be true, right? It might be. Bitcoin staking is exploding across new networks, but the risk could be catastrophic if you're not paying attention. Let's break it down what's really going on before your stacks get slashed.
In today's world, we have more or less two types of networks: the proof of work networks, for example, Bitcoin, and the proof of stake networks. For example, in the latest upgrade, Ethereum, which originally was a proof of work network, has become a proof of stake network. What does it mean? In the proof of work networks, miners need to basically buy computational power to mine Bitcoins, and so earn the rewards when they win the computational power race, solving the puzzles. In the proof of stake networks, you need to basically buy the original asset, the native asset of the network, and put it at stake, basically putting your capital at stake to earn the rewards of the network that are generated by the fees, in turn generated by the network.
So rather interesting explanation around the notion of crypto staking in general and how it particularly affects Bitcoin. So I'm going to run through each of the points that's been discussed at the CNBC Squawk Box interview by this gentleman. Now, the first point you can see in the list, Bitcoin versus proof of stake coins. It's true to say that Bitcoins run on proof of work, not proof of stake. And that's a crucial distinction. Unlike other coins like Ethereum or Solana, where holders can natively stake their coins in order to secure the network and earn yield, Bitcoin, on the other hand, doesn't offer that. It relies on miners doing real computational work, spending electricity and resources to validate blocks. So when you hear about staking Bitcoin, it's not the same as staking Ethereum. There's no native staking yield on Bitcoin itself. It was precisely designed to be trustless, simple, and secure. This is why traditional staking models don't apply unless you're moving your Bitcoin to an external or synthetic environment. So how can you actually stake Bitcoin? Well, it's not through the Bitcoin network itself, as we already discussed. It usually involves wrapping your Bitcoin or using it on layer 2 networks or synthetic staking platforms like Stacks, Babylon, or even centralized DeFi protocols. Essentially, you lock your Bitcoin into a smart contract or off-chain protocol that creates a derivative or representation of your Bitcoin. Then you stake that version to help power that alternative network. And your rewards, you may be asking? They're usually in the token of that chain, not in Bitcoin. You're effectively helping secure another ecosystem, not the Bitcoin network itself. It's like putting your gold into a digital vault and getting a promissory note you can lend out. It's productive, but with strings attached. From store of value to productive asset, historically, Bitcoin has been considered a store of value, a digital form of gold. It just sits in cold storage, accumulating value over time. But now, new protocols are flipping that narrative on its head. They want Bitcoin to become a productive asset, one that can generate yield without selling it. Think of it like turning your idle savings account into a high-yield treasury bond. This is a bold evolution. It appeals to long-term holders who want their Bitcoin to do more than just sit in a wallet. But, and this is crucial, we're moving from save and hodl to stake and earn. And that shift comes with new levels of complexity and risk. So, what are the massive risks involved? We've got to be super crystal clear that yield is never free. When you stake Bitcoin outside the Bitcoin network, you're adding a risk, a counterparty risk, sometimes a huge risk. Your Bitcoin gets wrapped or deposited onto third-party networks or protocols, and that opens the door to smart contract bugs, validator misbehavior, protocol hacks, or even network failures. If you're staking on a network with slasher mechanics, you could even lose part or even all of your Bitcoin. Worse, if the platform rug pulls or collapses, there's often no recourse. So before you chase that 6% yield, ask yourself this question. Is it actually worth risking 100% of your capital for a small return? And if you compare to Ethereum, so Ethereum staking is well known. You lock up 32 ETH and run a validator. But if you double sign or act maliciously, you get slashed. A portion of your ETH is permanently destroyed. That is the risk. Now imagine doing something similar with the Bitcoin on another chain. The same slashing logic applies whether you're staking on Babylon, Stacks, or elsewhere. If you don't follow the rules of the staking protocol, or if the validators mess up, your staked Bitcoin is at risk. You're trusting code, validators, and the underlying chain, not Bitcoin's proof-of-work security model. But despite the risks, there's a growing appetite for Bitcoin staking. Why? Capital efficiency. Investors want to do more with their assets. Institutions are especially interested in deploying idle Bitcoin in order to earn passive income. But remember, capital efficiency cannot come at the cost of security. We're still early in this experiment, and if done right, it could unlock trillions in dormant capital. But if we move too fast, without proper audits, fail-safes, and decentralization, the entire staking ecosystem could crack under pressure. So here's the final food of thought I'd like to leave you today. Don't stake your Bitcoin unless you fully understand the risks. That's the bottom line. If you're locking up your Bitcoin in a smart contract or third-party protocol, know exactly how it works. What's the custody model? What happens in a hack? Is your yield worth the risk of total loss? We've seen many DeFi platform collapse. Don't assume Bitcoin staking is any safer. It might be shiny and new, but it's not bulletproof. Stay informed, protect your stack, and think long term. If you enjoyed today's episode, please don't forget the like button, share the video to friends and colleagues at work, and if you haven't done so already, to please subscribe to my channel, as I regularly publish some interesting videos such as these, anything to do with Bitcoin, blockchain technology, and the future of finance. So till next time.